So, what are the biggest risks facing multifamily passive investors right now in Q3 of 2023?
Hey, accredited investors, I'm excited to announce that we have a new deal right now. It's a 49-unit building located in the horse capital of the world, Lexington, Kentucky. This is where the majority of the Kentucky Derby winning horses come from. Its rents on this building are 15% below market for renovated units in the area. To learn more, all you got to do is go to homeinvest.com or click in the link down in the description below. Always consult with a tax advisor, financial planner, or attorney before making an investment decision. Having said all that, all you have to do is go to homeinvest.com or click in the description down below.
If you're new to the show, this is Purpose Driven Passive Profits. His name is Nate Armstrong. He is the founder and CEO. My name is Steve Warner. I am the Chief Investment Officer, and we are here to make sure that you make sound strategic investments in this crazy time right now. Like, we are seeing the boat go up and down. We're seeing all kinds of stuff in the news. Nate, we are going to dive into some of the biggest risks in multifamily right now. What do you think number one is? What is the biggest risk facing people, and what should people be thinking about when they're jumping into multifamily investing right now?
Biggest risk, hands down, is the debt structure, not necessarily the interest rate. I know the interest rate sounds like the scary thing, but that's not the sword that comes around and cuts you from behind. The interest rate is a cost you have to factor into the deal, but it's really the debt structure. What a lot of people thought is that we removed the subprime mortgages from the world. But the reality is that the subprime mortgages, they just got packaged under a different name, different bundle, all that kind of stuff. And so there's still some really goofy loans out there that people can take right now, including smart, savvy people. Like there's these teaser rates on these buildings you can get into for 2 years, interest only, and hope that you're going to finish the project within 2 years and sell it. But the reality is that if the market doesn't allow for resale and you're stuck with one of these goofy loans, that's the double-edged sword that comes back and cuts you. And so it's the debt structure right now.
Okay, so let's dive into this a little bit more. What are the goofy loans? Is it an interest-only loan? Is it an adjustable rate mortgage? Who's taking these loans, and how do syndicators sell them? I know inside of our investments, we only do fixed interest and we do long-term. But a lot of syndicators out there, in order to make the numbers work, right? Because this is the thing, when you're shopping for a syndication deal, when you're shopping for a passive investment, you're looking for a good return on your investment. How do syndicators hide these, quote, goofy loans to somebody that would invest with them?
Yeah, the reality is that the average investor wouldn't know any better, because rarely does the syndicator talk about the actual details of the loan that they're getting. They might say something like, oh, we got it at 5%, it's a deal. But they don't talk about what happens when that loan expires. How long until that loan expires? How much over the prime rate can it jump? And so those are the real questions that have to be dug into. Or what would make you eligible to get into a new loan? We saw the case down in Houston. Houston, property taxes went up, insurance went up. And so one of the large syndicators that made national newspapers for losing their project to foreclosure, basically what they did wrong is that they underestimated what it would take to refinance into a longer term loan. And so just like you said, Steve, we have a different philosophy here. We don't like to take out risky debt. We want all of our debt fixed long-term right up front. And so long-term to us is at least 5 years. That gives us enough time to get through the cycles and take care of whatever we need to take care of on projects. But these folks that are taking like the 2-year debt and craziness, I'll get into a couple of the crazy ones out there, but those ones, it's like potential suicide of the project. That's the riskiest factor on the entire thing. In some cases, Steve, like the newest property we're working on right now, we're going debt free. We're going 100% cash on the deal, simply because we don't want to take any potential risk for our investors. We want to know that we can deliver 100% of our promised distributions, and we don't want to take any risk whatsoever.
That is a good thing. Something that comes to mind when you're talking about that, a question you can ask the syndicator, or something that I think will like kind of, it points to it, is if the syndicator says, hey, we're not paying any dividends for year 1 or year 2 until it is stabilized, that lets you know that there's something off somewhere in their equation. and that they're counting on more cash flow down the road. Well, I don't have a crystal ball. Nate, do you have a crystal ball back there on your desk? I
Yeah,
don't see it.
sometimes I shake it and and it's no, I don't, not at all.
That's like any investor that tells you that they know what is coming in the future, that is not how you want to count on doing the deal. At Home Invest, we make sure the deals are profitable from day one. And even if nothing changed, we would still be able to hit our exits. Now, these deals are fewer and far between, and they also come from a practiced syndicator that has been in the game for a while. That's one of the differences. Two of the things that I would ask right now, if I was looking at a syndication project, what is your debt structure? And what were you around during the last downturn? Because if you were active in the last downturn, chances are you're going to be able to weather this one pretty well. But somebody that got started in 2015, 16, 17, when the market was doing its hockey curve straight up, I don't think you're going to want to be with them. Nate, what is the other big risk that syndicators are running right now? Like if you were looking at a project, what would you be really careful of?
Yeah. Running the thing the way that it's supposed to be ran. A lot of people, they're jumping into properties and they don't know how to handle the phase after closing, the phase of what does it look like when there is a downturn in the market? What does it look like when residents and tenants do lose their jobs or you face a little bit higher unemployment rate? How do you retain people? How do you not have to turn over so often? Those kinds of moves. So as an example, like we got some folks that we're consulting for right now that bought a multifamily property in Pittsburgh, and they weren't ready for the bit of the rent decline that happens. The rents jumped up a lot last year. They went up 18 point something percent, 18.2 or 18.3% in Pittsburgh. And now this year they've come down by about 1.2%. And they weren't prepared for that. And so we had to go through and teach them some moves that they can make to fill their building. A lot of people don't understand what that looks like. So operations, you got debt, biggest risk, number one, and then number two is operating that property, doing it the right way to keep it full.
I'm trying to think of the questions that I would ask the syndicator, because you want to know, like going in, are you going to be able to keep the property full? And they're all going to say that. But what questions come to mind for you, Nate? What should they be asking?
So here's what I always ask our own team, and you can just use these as examples. We measure the 90-90. So that means that within 90 days of purchasing that asset, we have to be at least 90% stabilized. Meaning, when units turn over, or if a tenant announces that they're not going to renew, because we always do renewal stuff at least a month before they move out. But if we've confirmed to them that they're not going to renew, our building, to be considered stabilized, we always have to have 90% or more occupancy. And then when a tenant is going to move out, we have that unit re-rented within 7 days. So that means that we're pre-renting units. We're not waiting for the unit to go vacant and then coming in there and sprucing it up and then marketing it. No. We're marketing it while there's a tenant in that unit, and then we'll send in a crew to do a quick turnover in between, but there's a tenant already scheduled to move in. And so 90-90, get into the details, ask them like, hey, do you follow the 90-90 plan? Within 90 days, will you be 90% or more occupied? Like I would get into those kind of details.
I like it. I think those are really, really good questions. At the end of the day, I mean, most people are looking to work with somebody they know, like, and trust, and sometimes they give away their trust a little bit too quickly. What would you say going into fourth quarter this year? What are the biggest things that are going to cause capital calls, which is the dreaded thing for a syndicator? If you don't know what a capital call is, it's where you invest in a project and then a year, 6 months, 2 years down the road, the syndicator comes back to you and says, we need more money for the project. What do you think is going to be the biggest thing causing capital calls? Because I think we're going to see a lot of them. A lot of these people that got started in 16, 17, 18 that don't understand what's coming, we're going to see capital calls coming out for a lot of people that are in deals. What do you think is going to cause that?
Yeah, it's funny, Steve. I made a comment on someone, they were commenting on social media about cash out refinances, basically the BRRRR method: buy, renovate, refinance, pull all your money back. And I made a comment just saying, hey, those days are behind us. You'll have to wait till the next market cycle to be doing the cash out refinance. We're entering the cash in refinance. What that means is that, like, let's just say investors partner with a syndicator to buy something and then get it stabilized, and then they go to the bank for refinance. I wouldn't be surprised to hear about a lot of cash in refinances. The bank is going to do an appraisal and they're going to say, well, hey, yeah, you've improved the place, but you're still not at the level that we need. You're going to have to put more cash in this deal. It's going to be a commonplace then, because you have interest rates that are higher. So it makes the cost of debt more, which then kills cash flow. You have insurance rates that are higher. And a lot of states, they increase their taxes. Even Texas, which was one of the safe havens in this country, Texas just shot their property taxes up on investors by a long shot. And so there's going to be a lot of cash in refinances. That's what's going to cause a lot of people to do capital calls.
Well, that's, man, you want to talk about the tax jumps. It's happening because states have to make up for all the COVID money that they gave out. The government, I mean, like, the money's not free, right? But it is something that is stressful. Man, the cash in refinance, I think people aren't going to know what to do when that happens. What are 3 things that they should look for, or maybe 1 or 2 things that they should look for with a syndicator that they're going to work with? Whether you work with us at Home Invest, whether you go work with somebody else, what are 3 things that they should look for that kind of tip the hat towards this being a good, safe, sound investment?
Yeah, number 1, experience on exits, particularly. Make sure that the team has taken them full cycle. A lot of teams have bought stuff during the last few years, but they haven't actually sold, especially sold during a down market. And so I'd want to really check out their experience. What have they sold during a down market? Really dig into that. The other one is just operating. We talked about operations a little bit earlier in this episode, but operating during a down market is different than operating during an up market. When the government handed out checks to everybody, it was really, really easy to lease places. It was easy to sell cars. It was easy to sell TVs because there were so much money floating out there. But when money starts to restrict, people get more conscientious about where they're spending it. They're going to pay more attention to what they're spending it on. They're going to pay attention to things like, is parking included? Is it not included? They'll pay attention to, hey, does the clubhouse have a gym? Are there amenities that are nice and efficient for me so I don't have to go and pay a separate gym membership? They pay really close attention to that stuff. So during a down market, you have to operate differently. You got to be tighter. You got to be leaner. You got to present your best foot forward. You got to do those things. You should be doing it all the time. But when money's tight, people pay attention to it. So you really got to put your best foot forward.
Yeah, that is the world that we are in right now. If you want to hear about our latest deal, stay tuned right after this. This is going to wrap up this episode. Remember, when you are out there looking at properties, when you're talking to syndicators, make sure you are asking the hard questions. Make sure that you are making sure that they have good debt in place and that they have exited. And we'll see you next time here on Purpose Driven Passive Profits. Thanks so much for listening to our show today. Here's Nate with our latest offering.
Hey, accredited investors, I'm excited to announce that we have a new deal right now. It's a 49-unit building located in the horse capital of the world, Lexington, Kentucky. This is where the majority of the Kentucky Derby winning horses come from. Its rents on this building are 15% below market for renovated units in the area. To learn more, all you got to do is go to homeinvest.com or click in the link down in the description below. Always consult with a tax advisor, financial planner, or attorney before making an investment decision. Having said all that, all you have to do is go to homeinvest.com or click in the description down below.
We'll see you soon here on Purpose Driven Passive Profits.